Hello, my friend. How are you? I am so happy to see you again. I will explain today our trading model that happened today, and I want to show you something which is very important about uncertainty and how can you flip when the market is trending against your trade. I will show you something which is very important to you, and I want to show you how the market moving. Once the market reaching the high of the month, this three thousand four hundred ninety nine or 3,500. This is the high of the month. This is line is a high of the month. I want to show you this is a high of the month. Okay, this is line, and when I change to weekly, the line the same, monthly, weekly high, and on daily, the market already making this fair value gap, VA also fair value gap on H4, and also you can see how the market moving from this area to this area. The most important thing that you should know about is this rejection from this area and sweeping this low, this rejection of this area, and this fair value gap, which is very beautiful fair value gap H4. This is H4 fair value gap, and you can see how the market move in this area. On H2, you can see there was a fair value gap here against this fair value gap, and also their fair value gap here. On H4, you can see this fair value gap with this rejection. It's a very, very beautiful candle of rejection. And that means it goes with the buys because the market is trending in a bullish. So when we see something is different, which is the fair value gap that move against it, this is fair value gap, and this is also another fair value gap. These are this is called uh, fair value gap in the direction, the same direction of upward, and this is against. So when we mixed it, you at that time you know that the market may move downward, but it is not. Why? Because if the market decided to move downward, it should break at least this low, and this low. At that time, we will say that the market is trending bearish because this is higher high, this is higher low, this is higher high, this is higher low. So the structure is not goes with that. This is the first. The second thing, when we see the market at this point, I will show you the market moving downward, sweeping this low, affected by this fair value gap, then moving upward. After that, the market make another. When it reaches this fair value gap on H2, this is H2. And this is H2 fair value gap. Okay, plus inverted fair value gap, not only inverted fair value gap. Fair value gap and inverted fair value gap. Okay, the market when it's trending to this area, then moving downward and make a market structural shift. This is a market structural shift. So at that time, I decided to sell to at least to this point or this point, because if market affected by this, uh, the market is sweeping the high. Sorry, the market is sweeping at the 3,500 and then moving down, making fair value gap, and then market structural shift. In spite of this rejection at fair value gap on H4, so I make a sell in this area. When it comes to this area, you can see how the market move. I make a sell in this area, in this area. Sorry, sorry. This is the H4. Okay. I make a sell in this. The market here, when in the New York time open, the market here, after the market structure shift here, return to this area and make a collection, then moving upward, then make a rejection, then moving down, make another market structure shift here. This is the market structure shift. Okay, on lower time of 1 minute. This market structure shift. So I think that the market may move this area, then at least this low, at least this low to reach it. Okay, so make a sell I make a sell in this area and put stop loss here above this rejection. Okay, but the market trending upward and then hit this stop loss and moving upward, and I make a loss at that time. At that time, I'm waiting the market. Then the market return. On the market return, make affected by this 1 minute. So this is a sweep. This is a sweeping. This is a sweep through this box. So the market change its direction. This is a sweep. So I want to show you. Okay, this box is swept because it is accumulation, manipulation, and then distribution. So when the market make this market structure shift, this is market structure shift, and I return the market to this area, I buy here, then moving upward, then make another uh, fair value gap inverted with fair value gap. This also fair value gap inverted and this fair value gap. And I buy bot again here. Then the market moving upward, then return to this area to check it. My stop loss is below this point, 3,481, and it is not hitting. Then the market moving upward, then return to this area. Um, when I change to 3 30 seconds, 15 minutes, you can see how the market move, how the trending is moving. Okay, I also bought in this area. I also bought in this area. You can see how the market. This is market structure. This market structure. This is the market structure. The market return. I bought again. Then moving upward. Our target is 3,500. So on 1 minute, you can see the order flow, how the market move, and beautiful movement to the upward. How the beautiful movement to the upward. You can see this rejection. You can see on 3 minutes also this rejection is very beautiful. On 5 minutes you can see when I regard this not a sweep market structure shift, but the market rejected and moving upward, and this rejection, this rejection, that the market is moving upward, and this is not market structure shift. This is buy side. This is the sell side liquidity taken the liquidity from this area. So when the market change here, I can explain that I'm wrong when I sell in this area. I'm buying again. You can see this rejection on 1 minute, on 5 minutes, and making a fair value gap here and here, and it goes with our perspection that the market is well moving forward. This rejection is moving against the buys because already the market is moving upward, and I bought here this rejection and moving the market and till reaching the first target is 3,494 and 3,500. This is the second target, and trying to catch the trend again, and I'm looking for this 15 fair value gap, as you can see, again to enter in the market, this 15 fair value gap, and this is the high, and the market return retest this fair value gap. You can see how the market return to this area. I will show you because the net is different here. Okay, I will show you when the market rejected from this area on 1 minute. You can see how the market move here on 30 second. You can see how the market move on 15 minutes. I can see the market, how it sweep this fair value gap. Okay. And I bought in this area. I bought in this area. On 10 seconds, you can see how the market move. This is the market structural shift. This is market structural shift, market structural shift. But this is market structural shift. It goes with the buys, and the market rapidly moving upward toward this target first, and then return again, visit this area and moving upward. Or when we reach this area, you can see how we are trading in this area. I will show you something which is very important to see it. In this area, you can make what can you say, a rapid profits rapidly. You can see here that the market is trending down, then moving upward, making a market structure here, and changing the state of delivery also. Then return to this area. This is a fair value gap on 30 second, on 30 second. You can catch it here, and then moving upward to sweep at least this high. Okay, and also sweep this box, this box. So the market moving upward, and then return to this area, and you should go out rapidly when the market moving above this line and sweep it. Thank you very much, my friend. I'm so happy to see you again. And you should know and that you are going with the trading with the buys first, and there is a context, and there is a target, and there is a stop loss. And also, you can use the inverted fair value gap together with fair value gap. Thank you very much, and bye bye.